Welcome back, guys. This is Building a Million, one day at a time. So we had a request from one of the subscribers that they wanted to see a side-by-side of buying with cash versus buying with just 20% down and the differences in income and tax write-offs and stuff like that. So I've got it right out here. So basically, if you were to buy a property with cash, so let's say we've got $100,000 cash and we want to buy a $100,000 property that rents about, it's got a market cap of 1, so it rents about $1,000 a month. So that's $12,000 a year, okay? So we still have property tax and insurance, which is a tax write-off. If you're paying for insurance or property taxes, you can write that off against your income, which is about $1,050 for a $100,000 house. We do have depreciation, which this was rough math in my head. I did the math actually, and it's closer to about $3,700, but for these numbers, we're just gonna leave it at $2,700. That's going to be tax write-off you can write off your depreciation for 27 years on a property. We don't have any principal pay down because we don't have a loan on it, right? So this only counts if you have a loan on it. And then we have no interest with a tax write-off as well because there's no loan. So these are the numbers. If we make $12,000 a year, let's just say we're making about $50,000 a year in income. Our rental income, after we take out the property taxes and depreciation, puts us at still about $8,250 of rental income we're going to make this year, which puts us at $58,250. Now, if that's what our income is in the 22% tax bracket for 2021, we would pay about $12,815 in taxes, in income tax, okay? So that's not horrible, but that takes a big chunk of your income away. That means you're walking away with what, $46,000 instead of $58,000, okay? Now, if we come over here and we do a 20% down instead of paying cash, we're gonna buy that same property, the $100,000 property. We're gonna get the same rent out of it, but our income, instead of being $12,000 a year, is only going to be $3,300 a year. That would be our rental income after we pay our loan on that, okay? We have depreciation the same, but now we have that principal pay down. So our principal that they're paying down is going to be $3,756 for the year. Interest is $3,855 or $85, and we still have that same tax and insurance of $1,050. So all of this though so principal doesn't count as income. Depreciation, interest, and tax we can all use as a deduction. So if we add that in, we're sitting at about a negative $40 or $438 difference from over here of a positive $8,250. So that's a big difference there, which shows us an income. If we made $50,000 again, we're only at $49,565, which drops us into that lower tax bracket of 12%. And we only pay about $6,800. So we save ourselves about $6,000 in taxes because we didn't have to claim that income. Now, even though we still did make $3,000, it shows down here that loss of $438, okay? So overall, we're saving a lot of money. Now, the big plus of doing this, we still have $80,000 left over, right? So we could go out and buy 4 more of these. So we could have 5 properties total, which all these are benefiting. We'll take a bigger loss because we'll take $438 each property, right? So we'll show even a bigger loss than that. What would that be? Roughly $2,100 in a loss. So that would drop us down even lower. But if we did that, we would actually be making about $16,000 a year in income from 5 properties versus paying off that 1 in cash. We're only making $12,000, which actually hurts us because we end up paying more in taxes. So overall, this is the better way to go. It's going to be more beneficial to just put the 20% down to make sure that you're taking all the all the tax benefits that you possibly can, versus here you're not going to do that. Now, granted, this is just year 1 on a 15-year fixed mortgage. I think it was at like a 5.1% interest, and that's what it calculated for here in Utah with like a 740 to a 750 credit score. So even with that though, you're going to be more beneficial for year one. Now, down the road, as you're paying this principal down and you're getting close to paying it off in 15 years, again, you can depreciate this for 27. So this is a 15-year fix. After that 15 years and you've paid it off, then yeah, you're going to start paying higher taxes and stuff like that. But you may be able to cut back on your earned income because you have your rental income. Does that make sense? And so it's going to change the whole way you do business, because if you're making, what would that be, $60,000 a year from your rental income because they're paid off, yeah, you're not going to be able to take out your interest and your principal. However, you can stop working as much for your earned income because these are paid off and bringing in constant income year over year. Now, I didn't put in here the difference with appreciation and value. Again, if you bought a $100,000 property 15 years ago, that property today would be worth $300,000 plus. So that's the other thing. If you buy this today, 15 years from now, let's say this $100,000 property is worth $300,000. Well, at that point, your rent's gone up, so you're no longer making $1,000 a month in rent. You're probably making more like $1,600, $1,700, $1,800 a month in rent by the time that 15-year payoff comes and you're paid your loans off. So that changes things a bit different, but I didn't want to show you appreciation because it's hard to gauge appreciation. We don't know where the market's going to be at in 15 years. We do know that this is where we're at today, though, with how to take down your principal pay down and your interest with the taxes that we paid for 2021. So hopefully this gives you a little bit better idea on going out and looking for a rental property, what money you can make, how it benefits you to only put 20% down. Now, if we put less than 20% down, that's okay. We're just gonna have to pay a 0.5% interest higher for that PMI. That payment mortgage protection or insurance. So be aware of that. If you end up only putting $10,000 down, your interest rate's going to your interest payment's going to go up by 0.5%, and that's okay if you can afford it still. And on this scenario, we could, because we're still making $275 a month, which we could still cover that. And you could buy, let's say there's 10 of these available, and you want to just put $10,000 down on each one. That's still 10%, which is enough to get you a 15-year, well, probably not a 15-year, but let's say a 30-year conventional mortgage with 10% down. You could do that and have 10 properties instead of 5 and still come out ahead. So be aware of that. If you want to put less money down, that is an option. You can do that and still make decent money. If you like this video, make sure you hit that like button. Like and subscribe to the channel. Again, I try to post once a week about different financial tips, the rental market. The next video I'll post, I'll probably talk a little bit more about what's going on with the real estate market. There's a lot of people saying we're in a bubble, it's about to pop. Are we, aren't we? So stay tuned for that video coming up next. Hopefully I'll get that posted by the first of next week sometime, so you guys can get that and see if there's any information there for you to be able to make your decision on buying your next real estate property. This is Building a Million, one day at a time. We'll catch you next time.